focus of attention in the coming week from a top-down perspective will be the latest monetary policy decision from the European Central Bank. It's going to be the penultimate one under the presidency of Mario Draghi. He's going to step down at the end of October after 8 years in charge and be replaced by France's Christine Lagarde. But before he goes, markets are expecting the Italian to unleash further stimulus. Now, the ECB announced back in March that it would this month begin to offer more cheap credit to banks to try and get them in turn to lend out the money and boost growth via a third round of the ECB's so-called TLTRO, or Targeted Longer Term Refinancing Operations. On top of this, the central bank's got at least two more policy tools. The first is an interest rate cut. Remember that the ECB's headline on main refinancing rate is already zero. The deposit rate, the interest rate that banks get if they put money with the ECB, that's minus 0.4%. Yes, the banks have to pay, and that's an attempt by the ECB to get them to do something with the money and lend more. Now, this may sound like a good idea in principle, but the cost is eating away at the bank's reserves and ability to lend and ultimately their financial soundness. So the ECB may be unwittingly hurting the patient that it wishes to heal. Just check out the European Banking Stock Index. It's trading at levels last seen in 1993. Now, this chart goes back 10 years, but you get the gist. Both of those rates, by the way, well, they've been unchanged since March 2016. The second tool, well, that's more quantitative easing and buying of government and corporate bonds to try and drive bond prices higher, yields lower, so it's easier and cheaper for governments and companies to borrow. But with many bond yields already at record lows and even in negative territory, it remains to be seen whether this will help or not. This chart tracks the size of the ECB's balance sheet, which grew as it launched QE, created money and bought bonds, and it compares it to the benchmark equity index, the Stoxx Europe 600. Now, the ECB stopped adding to QE in December 2018, but its effect on share prices at least, well, it had seemingly worn off before then, perhaps because of fears of what it was doing to the banks. Now, company-wise, back in the UK, a fair few firms of all shapes and sizes are scheduled to release results, a trading update, or host their annual general meeting for shareholders, although only a handful come from the FTSE 100. Names that may be worthy of note, however, include retailer JD Sports Fashion and house builder Bovis on Tuesday the 10th of September, equipment rental giant Ashtead, aerospace specialist Chemring on the 11th, when troubled retailer Sports Direct will host its annual general meeting. Now, that could be interesting to say the least after its accounting and audit woes. We've then got real estate investment trust Safe Store on the 12th, and Eurosceptic Pubs Group JD Wetherspoon on Friday the 13th of September, and good luck to them with that. But for me, the stock most likely to cause a big fuss in the week ahead is grocer Morrisons. The FTSE 100 member is set to release its interim results to the end of July on Thursday the 12th of September. As we can see here, the shares have done very poorly indeed over the past 12 months, and they've actually sagged to what's pretty much a 3-year low, even though the Bradford firm increased its profits and dividend for the third full year in a row in 2018 and even paid out special dividends for a second time. Weak consumer confidence may be one reason for the slide. Concerns over Brexit and what it might mean in terms of tariffs, costs and supply chains could be another. But the real crux of the issue may simply be competition. The monthly UK grocery market survey from consultants Kantar World Panel revealed that Morrisons increased its levels of promotions as sales struggled, partly due to the tough base for comparison offered by the Men's Football World Cup and the hot summer of 2018, and also because of further inroads from those discounters, Aldi and Lidl. On a year-over-year basis, this chart taken from Kantar's data shows that Aldi and Lidl bagged an extra 0.9 percentage points of share in August 2019. Tesco came off the worst, losing 0.4 points, but Morrison lost 0.2 to take its total down to 10.1%. That's now well below the 13.6% combined share of those discounters. All of this means analysts and investors will look to 3 key sets of figures when the first half results are released. The first is like-for-like sales for the second quarter and the half. Morrisons has put together a great string of 14 consecutive quarters of like-for-like sales growth, excluding fuel and VAT. But as we can see here, growth has begun to slow markedly in the last 3, reaching 2.3% in the first quarter. That was the slowest rate of advance for 11 quarters. Second number is pre-tax profit. For the full year, analysts are looking for a 6% increase to 421 million on an underlying basis, so that rate of growth looks like a fair benchmark for the first half. A year ago, profits reached £188 million, including the new accounting treatment of leases under the IFRS 16 standard and excluding £52 million of exceptional costs. And the third number is the dividend. Morrisons paid out 12p a share last year, including 6p a share in special dividends. For the whole of this current year, analysts are looking for a 3.5% increase in the ordinary distribution. So again, that looks like a fair test for the half-year payment, which came to 1.88 a year ago, with tuppence as a special on top. Besides those headlines, watch out for progress on the operational targets that Chief Executive David Potts laid out alongside March's full-year results. They are a drive towards £1 billion in annualised wholesale revenues via an expansion of the supply deal with McColl's, and that's up from £700 million last year. Further progress toward the target of £75 to £125 million of incremental profit from wholesale services and online, and that's up from £54 million a year ago. And further positive cash flow to keep debt low. Net debt ended last year at £997 million, although do note that under those IFRS 16 accounting changes, leases worth £1.4 billion will come onto the balance sheet as liabilities. Thank you for watching, and I look forward to seeing you next time.